your own experience. Thank you, Ayanda. Share your experiences. You can drop questions in the chat, or you can raise your hand, and I'll do my best to, together with Ayanda, to make sure that we ask our panel. So I always sort of pride myself that we're very good with this program in two things. One is I always think we're very good in selecting people for this program. Some people that are participating, that is you. I think we always have a very good mix of experienced and more novice investors, and we always are able to sort of, that creates a very nice chemistry. And the second thing that I think we're very good at is to bring you very interesting and relevant speakers. And also this evening, we do not have one, we don't have two, but we have three speakers for you. And I hope we're going to get some healthy debate between the three partners. So in a moment, I'll invite the three guest speakers to introduce themselves. But in short, we have Keith, who some of you might recognize as the MD or the partner with Knight Capital, which is a Cape Town-based venture capital fund that has also started to invest outside of South Africa. It's also exploring the continent. We have Umulinga, who has become very active in the angel investment space, if I can say so, over the past years, but also has an extensive background or a track record as a banker, as an investor. There was a CEO period in your working life as well. And we have Siwu Steve, who is also a very experienced investor, angel investor. And I'm going to oversimplify a little bit, but the thinking of sort of bringing this panel together is that Keith has enormous experience as a fund manager, as a VC, has probably, not to brag or show off, but probably is someone with, I'm going to say, the most experience doing exits as a VC on the continent. And Keith can speak about that, of course, in much more detail. But in short, is a very experienced VC, and we ask him here also because as angel investors, we will find ourselves in a room with VCs from time to time, and it's good to understand how a venture capital fund looks at deals, what they what Keith sees as the mistakes maybe the angels make, or the value they can bring in your deal. And then Siwu Steve is an angel investor that has been around for a very long time, and also has experience both investing internationally, but also doing exits internationally. So also great to have you on this panel, and great to have you speak sort of from your experience also doing exits as an angel investor. And then, like I said, Umulinga comes with an enormous track record in investing in banking, but is relatively new, if I can say so, to the wonderful world of angel investing. Is also a graduate of this program. We're always super proud and excited when we can bring graduates. So Umulinga has, compared to the rest of the panel, less experience as an exit, but we thought that makes it very interesting to also have sort of hear Umulinga's voice, because she is right now putting money into companies. So the question then is, what should Umulinga in her position think about now when having sort of those exits in mind that will happen down the road? That's sort of a brief introduction from my side. So I hope I didn't sort of give away too much, but maybe Umulinga, I can invite you first to say a few words about your background, and then we'll do Siwu, and then we'll finish with Siwu Steve, and then we'll finish with Keith, and then we'll start the conversation for real.
Thank you very much, David, and thank you for having me. It's always a pleasure to be back. Indeed, I am an AAA alumni, and I really enjoyed the program, and it empowered me to become an angel able to lead deals. Before I was just a follower, so it's a great program. I'm very happy to see many fellow angels from Business Angels Rwanda on the call. They're raving about AAA, so well done, David, Ayanda and team. They're very happy, and so I'm very happy. I'm a fund manager. I've been working investments in Africa since 2008. Before that, I was investing in Europe. And I'm new to angel investing. I started only 3 years ago, and I did AAA in early 2021, and it really changed my approach to it, because I thought first it was extremely risky, too difficult, impossible, etc. Because it is scary to invest in Africa. Those of you that are doing it for your first few months, is normal. I was also quite scared, especially coming from a traditional investment background. And I'm happy to talk about my experience about discussing exit with entrepreneurs, because it's very important from the onset. So very happy to be on this panel. Thank you very much again for having me.
Thanks, thank you, Blaine. Thank you for joining. Steve?
Yes, again, thank you very much for having me today. I guess I'm going to have to represent also the Francophone, even though I'm Ghanaian. So I'm also now a fund manager where I'm raising the healthcare fund, a seed healthcare fund dedicated to East and West Africa, including Francophone. And I must say the journey to angel investing has been fraught with surprises, scars, and joys that I'll be very happy to share during this particular call. One of the things maybe that I can share is that I'm quite a versatile person where, depending on the sector I'm looking at, it's quite also leveraging on my previous experience as an investor, as a trader in equity derivatives and a consultant. And this is hopefully what I always bring value to the entrepreneur in that way. So thank you very much.
Thank you. Keith, please.
Yes, I think as David said, co-founder and partner at Knife Capital, which is a VC in Cape Town. But increasingly, partnering with other credible fund managers around Africa to increase our footprint. But on the angel side, I mean, interesting fact. So a couple of years ago, many moons ago now, myself and my other two co-founders, Andrea and Eben, as well as Brett Kumail and Wesley Lynch, who's now owns Snaplify, which is a startup, started a angel group called Angel Hub, which we invested and educated and basically created a network event around that and funded actually many startups in South Africa. And eventually that we sold that angel group to Michael Jordan, who is ex-F&B CEO, and he stepped into the startup space with that portfolio because he was one of our lead angels. And he turned that into Angel Hub Ventures, which eventually became Khalaisani Ventures, which is one of the top leading VCs in South Africa. So I definitely have my roots in angel investment and my career roots in VC in Mark Shuttleworth, which is a tech founder in South Africa that it had a massive exit and then created a VC fund. So very much have a symbiotic relationship, co-investing with angels. I'm an angel investor myself, but as a fund, it becomes conflicting. So we can't really invest alongside or in angel investments. So very passionate about the space, and for the ecosystem, this is a highly important piece of the puzzle. So yeah, would love to co-invest with some of you on the screen and also have some successful exits together. So we're going to discuss that today.
Very good. Thank you, Keith, and thanks everyone again for joining. Maybe to add, so Umulinga is also, correct me if I'm wrong, but also one of the co-founders of NIBAN, which is a Nairobi Business Angel Network. And then you also continue to have a relationship with the Angel Network in Rwanda. So far, so good. And then Steve, what is your relationship with the Angels in Ghana again? Are you?
So so we have Accra Angels Network.
Yes.
That we set up in 2018. And I must say it's been quite a tough journey, because before there was Ghana Angel Investment Network, which was a spin-off of a public entity that didn't work very well for different reasons. And on the back of that, we set up Accra Angels Network. And again, Ghana has its particularities that are creative challenges, but we do have individual angels who transact, but not compulsory through Accra Angels. So that's the relationship. We're still building Accra Angels.
Okay, very good. So I hope that everyone recognizes that we have a lot of experience on the panel today. And again, the floor is very much open for questions, comments, and share your experiences. But to kickstart the conversation, so maybe it's good, and maybe I can ask you Keith, to take the first question, but maybe it's good to sort of unpack for a second what does an exit look like? What does an exit look like in the context of Africa? And you know, maybe if you're a very no fees investor, you might think of IPOs, etc., and that might not be the reality on the ground. So maybe and maybe I can ask you as well. And again, not to brag, but if you can sort of briefly just speak through kind of the exits that you have done, also to kind of give some color or illustrate what we're discussing this evening. Thanks.
Okay. Yeah, look, I mean, there's a couple of questions there. So I think, interestingly, Knife Capital had to get our heads around the concept. And we actually get quite a lot of criticism for the fact that we are exit-centric business building, which is our sort of focus. So we build businesses first and foremost, but with the lens of an exit first and foremost. And a lot of people see that as, and this, I mean, public information, definitely some high profile founders and investors are saying, if you build something to exit it, you're not passionate about that company, you build to flip, it'll never work because you've got one foot out the door already, and that type of argument, and we totally don't agree with that. So what we see is every journey ends at some point. At some point it's going to be my last day at Knife Capital. At some point it's going to be a company's last day as a startup, and it might be because it runs out of capital. It might be because it gets acquired. It must be because you retire. It must be because an unfortunate bus incident. But what we find quite interesting is that people don't plan for that or adequately for that exit event, and thereby they leave a lot of money on the table. And to bring it more closer to home, we are in the business, all of us around this screen, in the business of building disruptive businesses that attract attention, that are high growth, that disrupt certain things. They either take clients from the incumbent or from the gorillas out there, or they become a new tech and fintech or whatever. And at some point they get noticed. People are saying, "Whoa, what's going on here?" And quite often that becomes into a client relationship, or sometimes it's like, well, are you for sale? And the answer is sometimes always no, but my house is not in Cape Town, not currently for sale. But if someone comes in there with a massive price, suddenly I'm telling the kids to pack the bags, we're leaving, so it just depends on the price, and my point to the story is we quite often get startups running into Knife Capital's office. I can't believe this. I got an LOI signed by Garmin, and can you help me to exit because I don't have a data room, I don't know what to do, I'm not ready, and I need maximum price. And we're like, well, sure. I mean, this is not something you can do in the last month of building this business. It's something you need to do in the first month of building this business, in terms of how you set up, where you are registered, how are you building your ESG elements. Yes, you need to build an EBITDA, but more importantly, you need to know what you are selling. And I'll get there in a bit of a later thing. So typically, any country in Africa, the ecosystem is not comparable to a Silicon Valley or a Europe, or where there is a robust IPO system. So, and we'll get back to that, the structure of our ecosystems later, which is good news for angel investors and sometimes not so good news for VC investors in terms of get out. But for the VCs, there's generally only one way to get out, and that is to sell the business to a strategic acquirer. Now, the good thing there, and because we don't have a robust IPO market and so forth, the bad news with that is you can kind of fool the market usually by creating hype around a startup. People don't really analyze the numbers. They want to get in on the next new thing, and you can kind of create hype and a listing and some PR, and people buy shares, and you can exit. But over here, you are up against a very experienced M&A team of Google or Garmin or General Electric or C-Sense or Visa or whatever. And those guys are brutal when it comes to driving down the price. They don't want to buy disruptive startups at a higher price than what their current listing trading is. So I think that's what we're up against. I mean, there's a lot in those few sentences, but you're up against getting a company ready to not be surprised when someone knocks on the door and say, listen, I find your business very interesting. And then maybe to the second part of David's question, if I can take you maybe to our, I don't know if you can see, can you guys see my screen, by the way?
Yeah, I know where you're going to take it.
So this is our sort of investment wall at some of our grindstone companies, but at the end here, I'll try and is our sort of exits, you know. So maybe just very quickly, and just some of it was luck, I must be honest, and some of it, you know, we had a strategy. But yeah, our first exit was a startup in sort of the mobile space, Red 5 Labs, the Fed Group. Big one was C-Sense.
Can you zoom in slightly more? Can you keep it slightly closer so we can? Yeah, there we go. Thanks.
Can you see that? And then C-Sense to General Electric. We had quite a big exit, Fundamo FinTech to Visa. That was a $110 million exit in a while. We had a company in radar technology, Ikubu, micro radar technology, that sold to Garmin, and that was a startup. I mean, that business was really less than 3 years old, 10 employees, you know, your typical business that you would invest in. We had a fairly larger business called FlightScope, which is also in radar, that first did an MBO for the one part of the business, and then the FlightScope tennis did the exit to IMG Arena. One of our favorite ones, probably the biggest exit in times money, was AutoTalk to Uber Eats, which was a 2018, was a online ordering business, sort of a smaller business, Taxtim to MMI Holdings, PayFast, and you might know was on our Grindstone program, exit to DPO, and OneCart to Massmart. We had a very interesting co-investment with Sequoia, actually, in a business called which was online sort of collaboration software to SoftBank. Westpass to FM Systems. This is ProGlove is a German-based business, which was just an opportunity to Nordic Capital, and we're busy with 2 exits at the moment. So those are some of the more notable ones. And again, it's more just to illustrate that these things do happen. You know, it's not as if we know everything about exit. Every time we go through one of those things, we learn that sure, we wish these things were in our data room, and we could have negotiated better if our IP was structured like so. But I think the main thing is that we've got such amazing entrepreneurs, and people notice them. And when we set them up for potential acquisition, they need to get maximum price.
Thanks, Keith. Yeah, maybe we'll ask you to. We would love for you to continue speaking. Maybe we'll ask you to park there for a second, just to give the rest a chance as well. So, and just to reiterate or echo the fact that you often hear across Africa that where are the exits? It's so hard to exit, etc. And that's all true. But I'm happy to have Keith here kind of showcase that, you know, it is possible. It does happen. And again, it's wonderful to have Keith here today to you know, with that track record to be with us. Okay, so there were, I mean, a few takeaways. So one that I would like to come back to at a later time is the difference between a sales price and valuation. When you kind of alluded to, it's great that we value companies in XYZ, but then you meet the acquirer, who's probably has a different way of looking at things. But I just wanted to sort of take the conversation also to see with Steve. So one of the things that you mentioned is that from day zero, you're into exit-centric business building, which sounds like something that someone should tweet about, but exit-centric business building. So, Steve, in your experience as an investor, is that also how you approach businesses, or as an angel, is that simply different?
Fine. Thank you very much for the question. And I really like what Kit showed us, which is very practical. You had the logos and everything. I think from a perspective of an angel investor, it's a bit different. So I would say as an institutional investor, you have a time limit due to the fund life limit. You have 5-year investment period, 5-year divestment period. So as an institutional investor, when you get into a deal, you already need to factor in the various options that you would have to exit. I think from an angel investor's perspective, I think I think that generally speaking, we take the longer view, number one. Number two, we're betting more on the entrepreneur and the capacity of the entrepreneur to ride the wave, which is the market, with the right product or service, and then support the entrepreneur to do so. So the perspective for me is slightly different, even though even as an institutional, you're backing the team, right? So the other point is, for exit, most angel investors really that I know who invest pre-seed, maybe seed, more rarely Series A, the whole idea from my experience so far has always been, let me invest early, help the team design a product, a service, et cetera, and essentially scale the company and help the company scale to a point where they get to Series A, where usually institutional investors come in. And what these institutional investors want is clean the cap table, right? Meaning, if you're a startup or an entrepreneur, you started with, I don't know, let's say 30 people on your cap table, and out of those 30 people, you have 6 who put the larger amount, and the rest is small, 10, 5, 3, whatever. When an institutional investor comes in, wants to put $1 million, obviously he wants to take more shares. So that what happens is that the cap table of the startup gets cleaned up, quote unquote, where it's acquired. And this is, for me, essentially the best scenario for angel investors. So you help a company that is being built over time, and then when it gets to an institutional buying out the shares at Series A or later, then you can make 10, 100, 200, 1,000 times your money. And this is it. So that's kind of the process. And I've been quite lucky to have a few of those. But I guess where the question arises as an angel investor is, okay, what is my time horizon? Do I have other commitments that I need to meet in the meantime? And how do I re-employ that money? And what are the options? But generally speaking, I would say if you're in tech, obviously it's clean cap table Series A or later. If you're doing more SME where it's more cash flow based, then the way you structure the investment is a bit different, where it's not going to be a convertible note or a safe, but it's more rather going to be revenue share or a debt convertible with an interest with moratorium, etc. Whereby essentially in a way you're getting less upside, but then you have more assurance, quote unquote, of getting your money back. So these are kind of the initial thoughts around exit as an angel or as a VC. Yeah.
Very good, thank you. I think there's also something I noted down. We can come back to it later, but there seems to be some kind of sort of maybe tension or difference in one way we talk about sort of patient capital, and angels have less time pressure to exit, right? As compared to maybe professionally managed money where you have a mandate to work within a certain time period. At the same time, it always feels that one of the main challenges for angels is that they run out of money, right? They make a first, a second, a third investment, and then until there is an exit, they might not be in a position to invest again. So is that patient capital approach the standard or the way to go, or is returning the money in a relatively short time, is it the best way? Because then you can sort of you can obviously invest again. Maybe we'll come back to that later, but just want to go to, and there's a question in the chat from Matthias. I'll come back to that in a second, but first maybe go to Malinga. So from your investor journey so far, and if you hear both gentlemen speak, is it how top of mind is exit for you, if at all?
So I think that thanks to AAA's training, now it's discussed from the onset with the entrepreneur. We just need to have an idea of what they think. Usually they're very young and they might tell you, I won't sell before an IPO, which is not a great sign because there aren't many IPOs in our markets that are working. When we discuss exits, we also discuss, we're very transparent. Myself, I've not had an exit, but it's been follow-on rounds on many of the startups I've invested in. And I'm keen to sell at the first opportunity, in the sense that I'd rather sell now and invest in an early stage again. And also I'd feel better if I have done an exit already and I've not had the opportunity. I was hoping that on the follow-on rounds, when American VCs come in, they would buy us out, but there was no appetite for that. They were just very happy to see us sitting there and now wait for them to lead on the rest. That was a bit disappointing. And I think for angels, I mean, in our ecosystem, like Africa ex-SA, which is less sophisticated, we have to be there for the long haul. I mean, as Steve was saying, it's not a 2 or 3 year thing. All the exits that are happening at the moment, it's mostly North Africa or South Africa. We haven't seen much in the rest. So yeah, we'll have to be patient, but it's very important to discuss it. If you go very early stage, talking to an entrepreneur that has never talked to VCs, it's really important to see what his view is, whether he's naive about IPO prospects or not, or whether he's understanding of the fact that you don't want to be stuck in there until you die and give that to your children. You want to exit. So if he talks to VCs in the later on rounds, I want him to, or her, to say that we actually sellers if there's a good price.
Very good. So, and again, I'll come to Matthias. Matthias keeps adding good questions to the chat, so I'll come to Matthias in a second. But so maybe just to get one point out of the way, which is, and I know that Keith's going to disappoint you actually, because the point about cleaning the cap table, and because I know that Keith has an opinion about how the money that he puts into the companies is being used. So, Keith, tell us about your view on buying out early investors or cleaning the cap table.
No, I think this sell at the first opportunity is music to my ears. Knife actually has a bit of a different view. So the general view of investors, of all of us around this table, is to put in money for growth. You say, well, look, I don't want really money to go secondaries. I'm not putting in money into a business for someone else to go buy a luxury car with the money that I give them. I'd rather let that money be used up in growth for increased marketing, sales processes, staff, products, all that kind of stuff. However, since this is an exit masterclass, it does actually, when you sit on that exit negotiation table, and there's with all due respect, a messy cap table. You've got VC, founder, and then you have angel with 5%, but then you have angel with 2%, 0.2%, 1%, 5, 0.5, and you have like 30 people on the cap table. Remember, if you are a shareholder, you have, even if you have one share, you have as much shareholder rights, or not as much, but you have shareholder rights as someone who owns 40% as a minority. And there are things that the exit or the acquirer would want you to sign, like warranties. I warrant that this business has never had fraud and never had and all the IP belongs to the business, things which an acquirer would want a reasonable shareholder to warrant. And then those warranties are generally joint and several, so they can go after anyone who they want to, and you guys must sort it out as shareholders. So then we've had a few situations where a 2% shareholder is saying, hang on, I haven't been at the front end of this thing, so I'm not signing that stuff. This is too dangerous, And then the M&A team of the acquirer says, okay, hang on, what does this shareholder know that they don't want to sign the warranties, and we have to, between us, like up there, because you're not going to sit with 98%. So a lot of it is smoke and mirrors for the acquirer. It's just a trick sometimes that the M&A team uses to negotiate against us. But shareholder alignment is one way, or shareholder misalignment is one way to destroy value quickly in a business, in a startup. So if it's easier to align 5 shareholders towards what is the right exit price, et cetera, timing, than it is to align 28 shareholders, So we are quite in favor of, let's say, anyone below 5% shareholding that wishes to exit. We will rather raise more and get a few people more. And as I said, it sounds terrible, but like cleaning up the cap table is more just aligning the remaining shareholder interest. So I think as an angel investor on the continent, if one doesn't get swept up in the unicorn building dream, and you're quite happy with a mere $100 million exit, you know, there is lots of opportunities to put your hat in the ring. It's unfortunate that it didn't work out for you in this case, but if just like investment 101, know what your minimum returns are. It might be X times money or an IRR, and say any business that gives me that IRR, I will consider selling on a portfolio basis. And then, yeah, you might bet FOMO later on when this thing turns into a unicorn, but you would have enabled it in a way to do so, and you can recycle that capital into the next business. So I think there's, you know, I'm very excited about the getting in and getting out of the angel investment thing in this pyramid where everyone has to wait until the end to so don't do that. Get out at the right time.
So just to have you found yourself in a situation where there was sort of misalignment, and how was that resolved at the time? Without naming names.
No, we've definitely had a few instances of misalignment, and we've had to resolve it by in certain instances with money, by basically paying people to sign a piece of document, or giving them because suddenly you realize in an angel that your 2% can block a lucrative exit. So it's okay, you need my signature on this piece of paper and I only own 2%. I'll tell you what, you 97% oaks figure out how to give me another % of upside, and then I'll put that document in the data room. So there's been, you know, a little bit, what do you call it, not unethical, but a little bit of like real capitalism at play, when suddenly you realize the importance of your 2% as an angel, and therefore, you know, it just makes an exit more difficult, you know. It's difficult already.
Very good, thank you. I just want to invite, so Matthias has added a number of different questions in the chat. Matthias, can I invite you just to ask them yourself, or, you know, pick the most burning one?
Hi, yeah, thanks. Thanks for the interesting conversation so far already. I have been, so one question on the put and call options and optionalities has been answered. That makes a lot of sense. I'm curious about these buyouts that we've been talking about in seed stage, Series A, etc. Like, how does this usually happen? Because if this is what I'm going for through the contracts that we set up, our strategy, etc., I would just love to hear, and it's good that we have angels here, but also VCs. Just love to hear from you how these negotiations happen. Mulinga said that, oh, there was someone who didn't want to go for that option. I think it was a Mulinga, sorry. And yeah, so maybe also from Keith, okay, you mentioned a good argument for why you would do it. Is it something that you encounter frequently? Like, what is there ways how we can plan for that option in a better way? Yeah, to design our strategy around it, and maybe the times where potentially money could get returned, etc.
Yeah, look, I mean, unfortunately, as I said, the first statement does stand, that generally people would want to invest and let all the money go through growth. But I think increasingly, as the cycle turns, you know, there's this concept of shareholder alignment and the cap table where the founders are incentivized and some of those shares recycled towards management. So the business can actually do a lot with shareholding ESOPs when that gets set up, and those shares need to come from somewhere, or the founders dilute some more. So the way to plan for it is maybe just to play a little bit of poker and chess with in the fundraise, to say, look, we are raising in Series A, you know, $5 million, of which $1 million are going to partially restructure the business, and $4 million going to exit, you know, I mean, sorry, to growth. So I think that one can put that as a thesis to the investors, and let them say, no, we want all 5 million to go towards. But yeah, I mean, I'm looking at this list now. I mean, Quicket, Snaplify, like most, actually 50% of our deals, there's an element of buyout, you know. So but it's usually not the majority of the money. So if you put in, so let's say 80% goes to growth, 70% goes to growth, and 20 or 10, 20 or 30% goes to buyout. So if you plan for that type of thing, you've got a better chance of saying, oh, we're raising $5 million, 1 million goes to growth, and 4 million is people cashing out. Then investors are going to say no.
Thank you. Matthias, is that helpful?
Yeah, I think that's helpful. So if it's reasonable and makes sense in the context, then it can definitely be considered. That's what I take away. So yeah, it's probably then also important to just be very mindful of how the cap table is looking like right now, and how these rounds could be structured well. So.
No, it is a big consideration. I mean, I think David will attest to when we were in 2 weeks ago or 3 weeks ago at that VC course, and we had to do role play as VCs and angels and coming in as investors and stuff. You know, one of the first things people go to is the cap table, like the dilution, and so it's a big debate. So people actually forget about the valuation of the business. It's like, what does the cap table look like towards the next raise? Because your Series B needs to be successful, your Series C needs to be successful, and if everyone just hangs around forever and no one wants to recycle their capital, which is your right as a shareholder, but then it becomes more difficult to raise the next round. So one has to understand the intentions.
Very good, thank you. Maybe a question for Umulinga. So kind of right now in this conversation, we talk about the angel investor as, I guess, an individual. I think in reality, we see a lot of sort of people investing in groups or syndicates, and then you speak as one voice, etc. And then in your case, you work both with Naiban in Nairobi and in Rwanda, and I think you also have also Dakar is a place you call home sometimes. So how do you is there a dynamic within the syndicate then? How do you align if shareholder alignment can really be challenging? How do you add additional complexity of being in a syndicate? How do you agree up front how you go about potential exits? Do you agree what an acceptable, so many X return could be, or how do you manage that process?
I think, so thank you for the question, David. It's of course more complicated as a syndicate than as a single angel, because angels are humans, and humans in numbers are always complicated. Like agreeing is always difficult, even about like what we're gonna eat tonight. So let alone when there's money, it's very difficult. And it's important to discuss it. And it's important to formalize it in the sense that angel investments, syndicate agreements, investment side letters, all these things should be drafted with the worst scenario in mind. And I think it's sometimes difficult to do it because you are super excited, you love the founding team, you love the idea, you love your co-angels. But these things, when the first issue arrives, do change, and you need those agreements to make this happen. It's very important to have a syndicate agreement between angels, because I've never seen an angel group agree unanimously about anything. So they will not agree about the exit price, that's for sure. They will not agree about the exit method. So you need a syndicate agreement that ties you to agree. Otherwise, I don't think it would work, because angels are not typically followers. They have opinions, they think they're super smart, so they want to always negotiate something a bit different. When you find a very early stage startup that is raising pre-seed seeds, usually there's not even an agreement between the founders. If there's more than one founder, you need a co-founder agreement, then you need a shareholders agreement. And it's very important, because even if you love the founding team and you think they are gelling perfectly and they went to school together, when there's money at play, they might not agree. And it's better to have a founding, like a founders agreement to use to sort things out, than to just rely on them calming down, on things changing, and sometimes the fallouts are very big. I mean, I've only invested for 3 years, and many companies, actually many of them, there's issues between the founders, and the founding team that you see today might not be the one at the exit at all. So these agreements really help. So always do it, and you will always feel not like you won't want to do it when you are investing, because when you're investing, it's honeymoon phase. You love the founders and you love your angels and you're in a good mood, and then you have money, and maybe later you don't have a job and you are not happy with the people refusing the exit. So have those agreements in place. It's better than not to have them. But it's actually a difficult thing to, it's a difficult discipline, because when you're investing, you are always extremely enthusiastic.
Very good. See you, Steve. I see you nodding. You wanted to add?
Yeah, no, I think all of what you said is so typical of angel investors. I think as institutional, we're a bit more rational in the way we engage with entrepreneurs, even if the love is there. But it's true that as an angel, we really, as I mentioned earlier, we really focus on, okay, do I like this team? Do we think we can achieve it? But all these critical components that are very, very important. Like I've had 2 fallouts of companies that I've invested in. And then I have a CEO of one of the startups that I actually don't know. It's like, who's this guy? But it seems things are working. So it's very, very important to have that in mind when you're investing. True. Yeah.
Very good. And maybe a follow-up question for you. So in your experience, who actually sort of initiates the exit? Is it the founder who wants out? Is it a buying company who knocks on the door? Is it a lead investor who makes introductions? I mean, maybe it's all of the above, but in your experience, take us through how these things actually happen in real life.
Yeah, it's really all of the above. But what I would say is, which is particular to the continent, is that there's a lot. I would say over the last 1.5 to 2 years, there's been a lot more appetite for in African M&A. Let me put it this way. So I would say there's a couple of transactions that have happened, like Stripe, Paystack, and bigger international players, tech players, buying out some of the companies on the continent. And I think Keith mentioned South Africa as an exception, probably to some extent Egypt, but South Africa has been leading that kind of international buyers coming in to buy transactions in South Africa. Egypt came in as well to some extent, but I think the latest biggest trend is in Nigeria. So you get these international corporates buying tech startup to come on the continent and get a footprint. What I've observed for the last 1.5 to 2 years, I would say, is more internal M&A within Kenya, within Ghana, or between countries where tech startup will buy out another one, like an acqui-hire, and essentially enable local entrepreneurs or local angel investors to exit. And this is the new trend I'm seeing, and I strongly believe that by the end of the year, and to some extent early next year, before investments pick up again, that internal within Africa M&A is really accelerating. And that's kind of the biggest trend I've seen over the last 6 months and a year, I would say.
Thank you. Actually, I think an interesting discussion point, and maybe we'll kick that one forward as well. But so, what can other ecosystems, countries do to sort of, as an ecosystem, to allow for more exits to happen if you're in Rwanda or Ghana, etc. But one other question, I think you brought up one interesting point, that maybe when we think of an exit, we think of an acquiring company really wants to buy this company because it adds to their portfolio, etc. But I guess there can be many different reasons of why exits happen. Maybe, and I'll ask all of you maybe just to join the conversation, but just question for Keith. Keith, have you been able to track what happens with your portfolio companies after they've been acquired? Do you know kind of if they were well absorbed in the company, or what happened? Maybe you can give some examples, and then we go back to the question on why people buy companies. Why do these exits happen?
Yeah, look, I mean, as always, and in terms of M&A 101, different cultures, specifically if you put a startup culture into a let's call it a boring culture of a big business. So some exits, the exit happens and the shareholders get successful monetary payout. It's quite good for middle management because your career path at, let's say, Fundamo, for example, Now you suddenly have a career path and a CV, and you're an employee of Visa, you know. And usually those big companies, you know, they do quite a bit of a song and dance of it. And they, you know, I remember the General Electric, you know, the CEO Global did a big presentation, and we value this business. You guys have been so innovative. So for middle management, it really is good because but generally some of these businesses get nicely integrated, and others, actually these big corporates, try one or two things out for a year or two, put more money behind the strategy, and then someone in boardroom makes a different decision, and you know, your whole strategy is gone, you know. So the founders never stay at these businesses for longer than 18 to the longest, I think, has been 3 years. They get frustrated, and even though they earn out, which means maybe it's $100 million exit and you get 70 million up front, and then maybe 10 million based on, you know, targets to hit or staying around. You know, even some guys just buy themselves out of their earnout because they just can't handle it. So as you know, the founders always leave. Middle management generally has a career path, and yeah, the, you know, so it's and the strategies half of the time don't work out, because the reason why that corporate buys the business is sometimes for a different reason than what you buy the business. I'll give you an example. So we sold, and it's not no beef against Uber Eats. I'm not trying to make them look. It was just the plan. So Order Talk, I mean, we built this business. It was a restaurant online ordering system, seamlessly like going into the back end of restaurants. You know, we didn't have a delivery service, but we enabled all of that for online food ordering. Mainly in the US and the UK, because the markets were just so much bigger there. We started in South Africa, but just realized, you know, the amount of food that gets ordered here versus there is just not. Anyway, so long story short, Uber Eats launched later in life, and they looked at this. And one thing we had is quite a lot of IP around the integration with point of sale systems, you know. So we had integration and APIs with all of them. And they basically bought us for that integration. They made a calculation and said it could take us 8 months to do that, or we can just buy someone for X million dollars. Anyway, they basically told us that's the plan, bought the business, and then just shelved the business model that we've been building for 8 years, and very proud of our recurring revenue. And they're like, well, we're not in the recurring revenue online ordering module. We just wanted the APIs into the point of sale system. So, you know, that's what we sold, and so be it, you know. So yeah, so sometimes they buy you for a different reason. So you need to know what the game is that they want to play. You know, sometimes they don't disclose.
Just looking at Umulinga and see if any other sort of examples you've come across why people buy, why these exits happen, who initiates it, where do they come from, etc.
So I don't have much of an exit experience, but I've talked to quite a few entrepreneurs that were asking me, like, what do I think of selling? And in some fields, especially like in the groceries ordering field, for example, there's a few players and they're buying for market share. And me, I'm like, yeah, sell. I mean, they're like, no, I really want to build a business. I'm doing this differently, and etc. And then I think that some entrepreneurs just love the business too much, and they think they have a better idea. And me, I'm like, just take the money and go do something else. Because the thing is that either they buy you, or they spend that same money at taking a market share. It's like the same, right? But I've always been quite a cautious investor in the sense that if you give me cash now, I take it, versus cash tomorrow, because tomorrow, like, everything can change. And actually, like, I think that African entrepreneurs, like homegrown African entrepreneurs, that don't have the exposure to the Valley or other places where you see multiple founders selling their business at the first occasion, I think they hold on too long. That's really my opinion. And you keep telling them, like, competition is gonna come, and then you won't have enough money to spend that market share. But yeah, there's a lot of naivety in our ecosystem because of lack of exposure.
Okay.
Right. There's actually a very disheartening experience anecdote that I have of what Umulinga just said. I've got a tech company that I've been supporting for too long. And essentially, I mean, the entrepreneur got 2 offers, like maybe one after the other, like 1 year and then another year, actually from a South African company. And on both occasions, he refused. And funny enough, on the first one, he refused even without telling any of the investors. It's like, yeah, they offered me to buy out, and I just said no. So you didn't talk to us, right? That's number one. Number two, the time after, it was like there was really a good offer on the table. We felt was great. The entrepreneurs just didn't want to sell because he said, look, the valuation is not the valuation, I can use so much more, etc. So it's like entrepreneurs, as you mentioned, who hang on to the love of the thing so much that they don't see what they could do. And I actually decided not to speak to the entrepreneur anymore because basically it pissed me off. But funny enough, after all these things, I realized that now this particular entrepreneur, who I call like typical hustler mentality on the continent, has managed to regenerate a level of revenue, expanding to another country, and has stronger partnerships. So his revenue did this for some time, and then now it's slowly picking up. My only prayer is that when he gets an offer this time, he takes it, because basically he's burned out. He needs to move on to something else. And this is very difficult for entrepreneurs to get to in terms of exit.
Sure. Okay, very good. I think there's a question in the chat from Brian. Brian Badahukwa. Brian, can I ask you to you want to ask the question? Otherwise, I can do it as well. I think it ties into this particular conversation. Sorry to put you on the spot. Sorry to put you on the spot, Brian. I can also take it if that works better. But yeah. So the question, I think it ties into this conversation. So the question is, what are there telltale signs that yes, this is the right time to sell the company? And obviously, it could be, you mentioned a burnout, or mentioned that the right acquirer. But I mean, it's also related to that shareholder alignment, and the founder has big plans, and you, an investor, have an agenda. So, what do you look for this?
Yeah, maybe a point on that. Again, it really depends on the alignment of interest between the buyer and the company and the shareholders and the investors in that particular startup. Okay.
Sure.
What I've seen is that, for instance, some people do acqui-hire, just like Kit mentioned. This particular case was IP, buying out an IP that they don't want to develop on their own. They identify that as a strategic one, just buy it out, and then basically maybe even fire the team, etc., because they understand the IP and then they don't want to use it. The other one is the acqui-hire, which is basically you want to acquire a team where you see talent, whereas the company is not performing well, but within that company there's like outstanding software engineers, potential people can be future product leads, etc., within another company. That's what happens. And there are a couple of exits that I've managed to do in that sense. I think generally speaking on the continent, that's what I was saying with the last 6 months or a year, and there's been a bit of a more tech M&A, and where potentially I feel like there could be a gap is lawyers or transaction advisors able to really put that out. And the other example maybe on the exit side is, and that I guess not many people talk about it, is just simply a secondary within a transaction, which is quite nice as well. So if you're an angel investor, you're coming in, you've invested, but then you got an institutional investors coming in, maybe you can do a secondary with another angel or super angel who is willing to buy more shares, or even sometimes the founders want to buy more shares to keep more equity in their business going down the line when you look at a cap table. So these type of secondaries are not too much marketed, but actually they happen and provide liquidity to angel investors as well.
Okay, very good. Thank you. There's an interesting conversation between Tess and Keith in the chat. I think I'm losing my audience here because they're simply bypassing and going straight to Keith. And there's also a culture class happening because Tess is asking about about returns and about multiples and Keith replies in IRRs. Obviously, there's a VC way of looking at return. There's an angel way of talking about returns. But Tess, can I ask you? You want to ask the question? You want to share it with the group?
I'm sure. Thanks, David. Yeah, I actually like that you picked up on that. So maybe it would. When Sarah was talking about the acquisitions, I'm just curious. When we're talking exits on the market, are people returning, 100%, 200% of their money? Is it less than what they invested? Both from an angel side, but I guess it would also be good to hear Keith's perspective from a VC point of view.
Yeah, look, I mean, I don't think there's a right and wrong. So I'll answer two questions. This IRR versus times money. I mean, I think times money is a little bit irrelevant if it's, I'd rather take 2 times money in 12 months than I'll take 10 times money in 15 years, so we can all pat ourselves on the back on how much times money we've made. But at the end of the day, you have to overlay that with the time value of money. You could have, your opportunity cost of your angel money is the money you would save on your house bond or putting it into another asset class. So I mean, I'm not saying it's irrelevant, and usually it works out, by the way, within the, someone talked about cycles, within the 4 to 7 year exit cycles, maybe a bit longer in 5 to 8 to 10 year cycles in Africa. It depends how early you invest. I mean, if you invest at angel stage and you wait all the way for unicorn stage, yeah, you're going to wait more than 10 years, but if you invest at angel stage, get out at series A or B stage, or if you get it in the series B stage and out at, that it should be a 4 to 7 year cycle. And generally that would mean about 3.5 times money should give you the returns of about 30% which generally this asset class should return. You guys take more risk, so you'll have more failure because you invest more early on. Well, it's debatable actually if it depends how your investment strategy, if you get on and recycle. So probably your returns should be higher, and then one should. Yeah, but just don't talk about times money unless you say I want X times money within 5 years or so. So just put a timestamp to the times money. So generally, if you talk exit multiples, it really is. So please don't take the next minute of ramblings as gospel, but it is fact that it has pulled back a bit worldwide for the listed environment. Everyone is conserving cash. So the valuations indirectly, people are not like freely, happy to just pay an extra multiple and so. But assuming growth, so assuming your business grows, the rule of 40% year on year and X plus in terms of revenue growth, and it's still burning, but it's got a good IP and a good team, and let's just assume all those things are sort of present. And it is in an interesting category, like, I don't know, EdTech, AI, whatever. You should get between sort of 5.5 and 7.5 times revenue multiples. If it's more of a boring industry, it should go down to 3, 4. If it's a more of an exciting industry, like let's call it AI, sort of algorithms and so forth, it could be 7 to 10. But and I think it's very rarely that you're going to get an exit at a higher than 10 times revenue multiple. And therefore, if VCs invest, like many people do, at a 24 times revenue or 40 times revenue priced round, and that's why I like safe agreements at angel investment stage of investment. You're kind of fooling yourself because you're never going to exit. If you look at one of the acquirability, I'm working on an acquirability index at the moment in terms of like what and measuring our portfolio companies, but invest at sensible valuations. Is if you invest too high, or you're on a cap table where VCs have invested too high. We're currently in a situation where we co-invested with a VC, and they came in later and kind of just invested a little bit too high from where and now they don't want to exit. And the business has an offer on the table, and it's basically saying no, it doesn't work for our IRR. So you might entrap yourself, and this is why lots of the larger VCs on the continent are sitting on their assets, because they can't afford to exit as a down round. So it looks better to have an unrealized business at cost on your balance sheet than to exit. So you can paint yourself into a corner. But yeah, so those are the general multiples, and those are the timings that one would see. And those are, I mean, we're currently busy with 2 exits, one in sort of the fintechy kind of space, and there we're struggling to get the guys to bite on the 6 times revenue multiple. They sort of more a little bit, or 6.5 is our offer, and they're negotiating us down a little bit. And another one is people will figure it out if I say what industry it is in. But anyway, another one of our portfolio companies, we're looking at more the 7 times revenue multiple. But you know, that you're not exiting at more than that unless you have an early stage business with proper IP that makes a strategic sense, and then people are not buying it for the revenue, buying it for something else. I'll let some of the other people chat, but I want to show you an interesting slide around what you would be selling at time of exit. It might help clarify some of these questions.
Sure. Thanks already. And yeah, while you pull it up. So maybe Umulinga, so in your syndicate, are there conversations about sort of exit multiples upfront in terms of what would be comfortable, often within that time frame, as we learn from Keith? But are those conversations happening with the investors, with the angels that you invest with?
No, we're still a bit too early in our process, but we do talk about, I mean, some of the NIBAN angels have had exits. And I mean, some of them are telling us that now the time is not as good as before because of this downturn. We'll see how long it lasts. But we do discuss it at entry. I mean, I think it's quite important to have to discuss the entry valuation. Many entrepreneurs at early stage don't like to do it, but you say like, yeah, this valuation is like 10 times revenue. Like, to me, that's good, but more, you have to explain to me why so much more. And some entrepreneurs won't hear any of it. They say like, yeah, that's not how it works. But yeah, to me, it's like a sound check. Those multiples on those early stage revenues. But yeah, like it's easier now than it was last year for sure.
Okay. So we have about yeah. Sorry, Steve, you want to come in as well?
Yeah, maybe just a quick one. I like recommending people to have a look at the Brighter Bridges. At some point last year or this year, I can't remember, they had quite an interesting graph where you'd see pre-seed to seed, seed to Series A, Series A to Series B. What are the multiples at which, you know, those companies multiplied their revenue? So, and that's quite useful for me as a benchmark then. I guess it has changed now, but it's also good to have that kind of as a framework to look into.
Let's see how fast Ayanna can put up that link and put it in the chat. So we have about a good 10 minutes left in the call, and I want to sort of preserve the last minutes to talk about sort of, you know, recommendations and tips, and, you know, what would Keith, for example, advise angels in the room to do and not to do, etc. But I wanted to go back to one topic. It was a question from Anand already, not in the chat, but already on our online learning platform. I don't know if we have Anand in the room, but otherwise let me just spell it out. So the question is, it goes back to, you know, some of the markets that we operate in. So today we have people from also from Botswana and from Sudan, Ghana, Uganda, Rwanda. So some of the markets we operate in simply have less. There have been less exits, and so what are thoughts from the panel on how to move the needle in those markets, or should an entrepreneur or founder in Botswana simply look overseas? Should they automatically go to look overseas for exit opportunities? What are your thoughts?
I think, just if I can quickly jump in, I mean, there is a huge shift specifically towards capital allocation and capital efficiency and those type of things towards away from the big four of Egypt, Kenya, South Africa, and Nigeria. So I think when you are in Rwanda or Botswana or Uganda, Senegal, Morocco, Tanzania, yeah, I mentioned Ghana, I think. It definitely is becoming quite an interesting place to be a founder or to be an angel investor or an investor, because, you know, when there is hype, overhype, there's the risk of, you know, the sheep mentality, people buying in and pushing up the prices, where you could, and when those markets are overheated, or even if they're saturated, or even if you can copy certain models, just like we do in Africa, copy models from the US, and then when the US businesses come to Africa, they then acquire, you know. So just the same thing is now some of the big fintech businesses in, you know, Nigeria or East Africa are on an acquisition strategy. And we've got two of our businesses at the moment that actually are profitable, and the growth is slowing down. So we're like, okay, well, let's pump in some money to go on an acquisition strategy, you know. And these are not late stage business. These are startups put in $10 to $20 million or scale ups, and go and acquire smaller businesses in markets like Uganda, you know, and those type of things. So I think there's definitely an exciting space to be in markets which are not, you know, your typical big four. But and maybe if I can, I don't know if you guys can see the slide that I've got on here, but, you know, I think this is just from our from our exit content that we sometimes share. But basically, you need to really do that partner universe up front. You know, who might buy the company. So in due diligence, already figure out who that is. And sometimes someone asked, like, do you wait for inbound interest, like companies coming, or do you actually go and put it into a process with an exit advisor, which at some point, if a company is big enough, we would advise. But sometimes you just need to make sure that you bump into the potential acquirer at a trade show, or you follow or put your ads on LinkedIn so that they recognize you. And there's ways to, you know, why would they do it? You know, you need to try and do this. And obviously the strategic value versus financial value. I mean, there's an Excel spreadsheet value of a business based on multiples, and then there's a strategic value of a couple of extra clicks, and you need to figure out what that is. And really for African businesses, because unfortunately, and I hate to say it, this cliche from specifically international acquirers are that this is a you know, non-ideal governance continent of governance, and therefore it's too risky so most of the due diligence, and this is fact, of an international acquirer on any of our businesses, 50% of that DD was to do with ESG and nothing to do with the product and stuff, just the risk of buying this business. And this just quickly, lastly, when you are kind of thinking of why would someone buy that business, it's not necessarily going to be for the growth. It might be for the sales channel through Africa. It might be for the customer base, or the fact that one has a team, an acqui-hire that Steve was talking about, or for IP, or for, you know, the fact that you have more than $10 million of revenue. So your growth strategy has to support your exit strategy, and that's the thing. Is if someone is going to buy a business for its team, then you better make sure everyone's got a very solid signed employment agreement and are incentivized to stay and are, you know, like, are in it for the long run. Different strategy if it's for IP or whatever the case may be. So I think you have to think about the exit strategy, because otherwise you're going to grow for the sake of growing, and you're going to have a suboptimal exit.
No, very, very interesting. I think that Ayanda will ask you if we could use those slides and share them with the group. So maybe just one follow-up question, then we'll take it to see with Stephen and Untitled. So you started an hour plus ago with the comment that you're in the business of building, you know, exit-centric businesses, and obviously you're very you know, connected in Cape Town and South Africa, etc. But then, you know, given that you now also invest internationally, is that a hurdle? Is that a challenge, or is your business so international that it doesn't really matter? You know, you need to find buyers in overseas anyway. So, but I mean, or will you? You know, are there concerns about going into countries where you are less familiar with that exit territory, or then indeed do you find you co-invest, or how do you go about that?
So just quickly, we would lead things in South Africa because we feel, you know, we've got the stripes and stuff. We will and the connections, and we know the ecosystem, we know the entrepreneurs, we can make a few reference calls, and we know the vibe. We will not do that in other ecosystems. So we definitely will only co-invest with angels or with whoever, because we're not going to go and compete with VCs and stuff in an ecosystem which we are not necessarily have better deals. We will. I mean, why would someone want money from Knife when they can get it from TLCom in Nigeria? Like let's rather work together. So at the end of the day, we have to. So firstly, and then on the exit side, I would say that it doesn't really matter where the business is, because we are actually big proponents of using an exit advisor. So we would rather pay the 2 or 3 or whatever percent, because they always add more value in terms of getting the data rooms ready, getting a buyer list together, presenting to them. So unless it's inbound interest, in fact, in that case, you don't have to worry about it, because then someone comes knocking on your door. But if we feel the company is now acquirable and we take it to market, we would generally, even in South Africa, we would not do it as Knife. We would go and we're working at the moment with 2 exit advisors for our exit. So we would rather partner and get the professionals to do it. I'm a VC, I'm not an M&A expert yet.
Okay, very good. Thanks, Keith. And then back to Stephen Mlinga. So the question about the exits in other ecosystems. So the countries that you operate effectively, do you sort of identify major gaps, challenges in the ecosystem, or do you see things shifting, or do you see opportunities, or what does it take to get these deals done in Rwanda or in Senegal or in South?
Yeah, as you're correct, I invest mostly in countries that are not in the big fours, even though I've invested in Kenya and Nigeria. I actually, so most of the founders you would find in those smaller markets don't think they're going to be acquired by a player from Kenya or from South Africa or etc. And usually in my conversation with the founders, I actually tell them that they should still reach out to those people just to know what they're doing, what they're thinking. And especially in markets where we are more shy, like Rwanda, I mean, we shy people. People don't like to reach out to bigger companies in larger markets, but I do the intros, and usually after some time they do share information, they do discuss the market, and I think that this will lead to them doing good exits later on. As Kit was saying, there's increasingly interest outside of the big four. In the case of Rwanda is usually punching above its weight in terms of interest from investors. So the startups in Rwanda are getting a lot of interest from other tech players in larger countries, or even from outside the continent. And I encourage the founders to open these bridges and start discussing, because it's important they socialize themselves with the idea of selling their business to one of those companies. And yeah, I think it's going to happen more and more.
Yeah, I would say smaller market also have their opportunities, but I would say that to some extent, unfortunately, the continent is still kind of split between the 2 main languages, quote unquote, which is essentially English and French-speaking countries, with unfortunately, limited overlap, even though there's some coming in slowly. So when companies are looking at an exit, typically I would say West Africa is going to be, Sierra Leone, Nigeria, Ghana, and I'm forgetting the other English one, Liberia, and then obviously the other ones, right? So all the Francophone, Senegal, Cote d'Ivoire, etc., will look into exiting between those countries. So that's one of the biggest challenges I see. I think East to Southern Africa is much more kind of homogeneous in that way, but it's true that beyond this, the big four, the transactions are quite limited. Maybe what I'm starting to see much more of interest regarding exit and expansion, etc., is, I would say, Northern Africa towards West Africa, in general, or Northern Africa towards East Africa, like Egypt to Kenya, Morocco, Tunisia to West Africa, Francophone most of the time. And this is also happening where there's kind of a bridge between those two. But exit markets in those countries are a bit more difficult to manage. And I guess also because of the legal framework, like for Francophone or the OHADA law, transactions and advisors, etc., are also very limited. Look, I don't know if there's any other market apart from South Africa, to some extent Egypt, where there's actually M&A advisors taking care of exits. I don't know any actually. So yeah.
Very good point. So we're heading
So
towards.
just quickly on that point, and the reason why is because M&A advisors don't typically want to take on a mandate where the exit is not big enough for them to, where it makes sense. If you know, like the $50 million exit is just as much work as a $10 million exit, and you can't charge outsized fees. So, which brings, maybe it's an interesting point as you guys were talking. So typically, and it's just a number to put in the back of your head, is, you know, historically, if we go out to sell the business internationally, at least $10 million of revenue seems to be like a thing, you know. So generally, a business basically does not exist on the international stage, and it's very difficult to exit businesses until it. So in terms of acquirability, in our world, as soon as any of our portfolio companies reach that mark, then, you know, they become more exitable than the business who's got $5 million of revenue. So maybe if businesses are in these other countries, they become, or smaller countries, it's more difficult to grow it fast versus Nigeria or Kenya to a $10 million. And it's just I mean, as I said, not hard and fast rule. It just seems to be a question that we get asked by acquirers the whole time. So it must be something in it.
Very good. So we have a few minutes left, and then I want to finish the call with sort of a round of tips and tricks, if you will. But before I do so, and Keith, sorry to keep calling on you, but you bring such interesting all panel members, of course. But obviously, as a VC, it's great to hear your insights. But so, is there you know, what is like the one thing that you see angels doing wrong from your perspective?
Look, I don't think many of the angels that come from introduced by you or that we co-invest do this thing wrong. But the one thing that kills a deal at Series A level is when the founders have too little equity left before they get to us. So we often see where an angel is put in for 50% of the equity or 40% of the equity, and not because they're greedy or malicious or anything. It's just sort of startup needed money. I'll put some money in, but I want 40%. And that was maybe a certain number. Now we have to put in, our Series A, and we're going to dilute the founders. We're already at 60% to below 50% at Series, and at some level, it becomes. So I think the one thing angels can do is maybe just look at the safe instruments and the normal things out there to invest there, because while you want it will work against your returns, because while you might be very excited that you own 60% or 50 or 40% of the business, you might not be able to get growth capital from sophisticated investors if they look at that cap table and it's already screwed before you even get to Series A or B, Yeah.
Can I add something to that?
Yeah, please.
Yeah, so it's actually one of the first comments I make to any of the entrepreneurs I support. I tell them, look, I'm happy to put money in, but look, I will not allow you to shoot yourself in the foot in a way that when you get to Series A, you own less than 50% of the company. So I always tell entrepreneurs, whatever round you raise, pre-seed, seed, bridge, whatever you call it, before Series A, dilute yourself for each of the round 15, 20% maximum. So that means if the team own 100% pre-seed, when you get to Series A, that's like 60% or a bit less, but closer to 50, nothing below that. because otherwise you're shooting yourself in the foot, and then basically you become an employee, the motivation and other things like that. So that's a very, very key point that Keith just made.
Thank you. Mulinga, over to you. You wanted to share some last, because I want to give it back to Ayanda for sort of closing comments, but any last words of wisdom or questions or tips for this audience?
So I don't have much more to say. I really agree with everything that was said by Keith and Sewu, and really I also learned a lot from this call. So thank you very much. On the point of dilution of the founders, it's super important to leave the founders motivated enough so they will get you the next those uplift in valuation in the next round. And in smaller markets, it's quite difficult to convince angels to do so. But I'm not happy angels owning more than 10-15% because we become too big and we become a hurdle to the next rounds. And then there's also like no point asking for board seats and all these things. Maybe a board observer, but the board seats, to be honest, we all sit in enough meetings. Why have more meetings? We don't want to sign documents all the time. And then if you're on the board, it also looks like you are an encumbrance to lead investors coming on later. So that's really important to see that you are there only for a certain amount of time. You shouldn't wait until that company becomes a unicorn. It's too long, and you shouldn't be as Sewu was saying, like shooting letting the entrepreneurs just do the wrong things for the long-term profits. And on the point of advisors, actually they are advisors in smaller markets. They would just charge much less. And angels are not keen to use advisors. They're not keen to pay lawyers because they often are very cheap. And that's really being, how do you call that? Penny-wise, pound-fool, because it's really worth getting professional advice. Even myself, that I have done investments and M&A at a larger scale, but I don't know all the laws in Rwanda. I don't know the practice in Rwanda. I don't want to start reading the company code in details. I'd rather pay a lawyer to advise me. It's really worth it. And there are investment bank like boutiques in all these markets, Rwanda, Botswana, Sudan. So reach out to these people. It's really worth it.
Very good. Very good. So, Keith, you had a final.
Yeah, I think it's such an important and exciting space. You must remember that up to even very recently, South Africa did not have in the VC space any institutional capital. So we are really built on the shoulders of angels as an industry. And so I think it's an important role that angel investors play. I think the thing is, one has to have a asset allocation across other asset classes. I mean, hopefully you don't put 85% of your wealth into angel investing, and then the idea is just be there for the startup. Most often they need more psychological, like motivational assistance and than money, and start partnering with the VCs early on, because the other mistake that angels make is thinking that a couple of 100,000 or whatever numbers that you invest is going to be enough, and very quickly the company has cash flow issues, and then you're on the cap table as a shareholder, and before you know it, and I'm sure all of you have been in this situation, as have I, you've put in more money and more money to bail them out over payday, and more money, and then you start like suddenly being out of your comfort zone of what you wanted to invest. So make sure that you make friends with the follow-on funders. I'm not saying it's other angels, VCs, whoever, so that you make sure that there's a path to the next round. If you can't see the path to the next round, then don't invest, because you're going to paint yourself into a corner.
Very good. Thank you very much. I want to take a moment to thank the panel. I think it was a wonderful conversation. All Sewu, Steve, Mulinga, Keith are all available and active on social media, LinkedIn, Twitter. So please follow them, reach out to them. Ayanda, can I give it back to you for final closing comments and tell people to do their homework and that kind of stuff?
Yeah, not much homework, but mostly just to echo onto this point of the showcases. So we are barreling towards the end of the program. We're not at the end yet. This was the final masterclass, but not the final event. The actual final event is the startup showcases, for which nominations are now open. I've put the forum in the chat as well. So if you'd like to nominate startups for our showcases in Sudan, in Ghana, in Uganda, and in Rwanda, please use that form. And once again, these are startups that we're going to select that are going to present right back to this forum of investors. So if you have deals that you're looking at that are interesting, or have deals that you're open to that you would need, you know, like say what Steve said, follow-on funding or more money, like Keir said, that path, this room is your path of people with money in their pockets that could help you along that way with those startups. So please, once again, the form is in the chat, nominate in there. Next week, we have Hannah Subai for the Q&A from ABAN, if those of you who don't know that. So we still do have, I think, 2 more cohort events coming up. But yeah, Monday, the next module is available. And if you have any questions, like I said, you can definitely reach out to the panelists on their social medias. But if you have any direct questions that you'd like us to collate and to send back to them for some formal answers, we can also send you their rate cards because they don't come for free. We pay them too. So anyway, thank you very much, everyone. And yeah, David, that's it from my side.
Right. Okay, thanks everyone. Thanks for joining. Panel members, thanks again for joining. Ayana, thanks for helping to host. Enjoy your evening. Talk soon again. Thanks everyone.
Great
Bye.
stuff. Thank you.
Thanks everyone.
Thank you. Have a good evening. Cheers.
Thanks everyone. Thanks.